Well, first up on the show, we're going to talk about corporate India, what we can expect in FY24, particularly on the operating margin trends. Now, India Inc.'s operating profitability had seen a very sharp contraction in Q2 and the first half of FY23. Now, Q2 EBITDA margins, according to the Motilal Oswal study and the companies that they cover, ex of financials went down by 540 basis points in Q2 year on year. If you look at the performance in the first half of the year, the margins were down 510 basis points at multi-year lows. These are the companies that they track ex of financials. However, we've seen a recent commodity price correction, and that, according to them, is going to drive a margin pickup sequentially in the second half of FY23, which will extend into FY24, which is why they've titled their strategy note Theme 2023 as corporate margins to rise from the ashes. Sectors which had seen a deep correction in margins will drive the recovery. That is cement, metals, oil and gas, consumer, auto, specialty chemicals. These are the sectors which will drive a margin expansion in the second half of the year and FY24. Gautam Duggad, the head of research at Institutional Equities at Motilal Oswal Financial Services, is now joining us on the show to talk about this. Gautam, morning, and thanks for joining in. Rima here. Can you talk about this strategy note, the expectation on the margin front? What is it that your analysis and expectations have thrown up?
Hi, Rima. Good morning. Thanks for having me. So the context is very simple. Last 18 odd months, we've seen that the corporate margins have taken a big knock, because of a variety of reasons: commodity price inflation, supply chains getting disrupted, and in several sectors, corporate decided not to pass on the price hikes because the demand was very shaky. So the net result is that if you look at a broader universe of NSE 500 companies, between December 20 to September 22, if you look at their top line, it has gone up from 20 lakh crores to 30 lakh crores. So net accretion of about 10 trillion rupees. But if you look at the EBITDA from the similar period, the EBITDA accretion is just about 33,000 crores. So on a top line of incremental 10 lakh crores for NSE 500 companies, you got an incremental EBITDA of just about 33,000 crores. And for profits also, the accretion was just about 36,000 crores from 2 lakh crores to 2,35,000 crores. So essentially what it meant was margins took a deep dive from 21% to about 15%. So that is 600 basis points for the broader universe. For our coverage universe, as you mentioned at the beginning of the show, the gross margins are coming in at a multi-year low of just about 29.5%, and EBITDA is also at about 14.7%. We are now expecting that second half FY23 and FY24 will be the period of margin recovery, barring any unforeseen events, which are definitely not predictable. But at the moment, when we look at the numbers, it seems to suggest that second half and 1H, or rather full year FY24, we will see somewhere about 200 to 250 basis point of a recovery on both gross and EBITDA margin front. And as I mentioned, the sectors which took the margins down will be the sectors which will take the margins up. So broadly, your commodities like cement, metals, oil and gas, and then some of the B2C companies and sectors like consumer and auto, where we are expecting margins to show a semblance of a recovery. Be that as it may, your margins in FY24 will still be lower than the pre-COVID gross margins. If you look at FY17 to 20 as an average period for pre-COVID, both your gross and EBITDA margins will still be lower versus the pre-COVID period, despite seeing a recovery from where we are right now.
Okay. Gautam, hi, good afternoon. Just a follow-up, you said that autos are expected to see a margin improvement, but is it as simplistic as that? Because on one hand, raw material prices are coming off, but on the other hand, there are large discounts being given, right? Whether it's in the small car segment, in the commercial vehicle piece. Do you think it will offset the positives from lower raw material costs? And how do you deal with the stocks then?
No, it's never simple. When you look at the interplay of various cost line items on a P&L, it's never linear that you got 10 rupees of saving in raw material and you accrue everything to your EBITDA. It will always be a function of how your demand is shaping up. Specifically for auto, we are seeing three forces at play. One is the terrible supply situation on semiconductor front, which used to prevail till about June, July, has shown a marginal easing, which is what the corporate commentary during the second quarter con calls across auto sector suggested. So your supply situation has eased up. Second, demand specifically in four-wheelers and CV is looking quite robust. Two-wheeler is still in doldrums. And third, incrementally, your margin, basically the commodity price pressures have eased off. So combination of these three will definitely provide a positive catalyst for margins. To an extent, it will get mitigated by any discount that may be on offer going by segment to segment. For example, there might be a case where a particular company or a particular segment is facing a demand pressure. So they may want to pass on a higher discount. So that can always happen. But at an aggregate basis for auto sector as a whole, we are still seeing a margin improvement at the gross margin front by about 130 basis points and EBITDA margin by about 200 basis points over the next 2 years. Do remember that this is all coming off on a very low base. If you look at the auto sector profitability in 2018, in Nifty, it used to be 28,000 crores. We ended FY22 at about 8,000 crores, and our expectations for FY23 is 21,000 crores. So on a 5-year basis, the profits are still not back to where they were in FY18.
All right. Hi, Gautam. Morning, and thanks for joining us. So, you were saying that margins are going to pick up in the second half of this year, that is in Q3 and Q4, and then in FY24 as well. Can you break it up a little bit more, as in like how much of an expansion should we expect in, say, the cement pack, in the, in the metal pack? If you could break it up for this year and then for the next as well.
Yeah. So roughly, as I mentioned at the beginning, sectors which took the margin down were global cyclicals and some of the other commodities and B2C sectors like consumer and auto. And we are expecting the same sectors to lead the recovery going forward. So for example, when it comes to gross margin, we are expecting a cement sector to report a margin expansion of about 400 basis points, consumer at about 250 odds, metal somewhere similar, and autos, just I mentioned, 130, 140 basis points. When it comes to EBITDA margin, again, the same sectors, you will see margins recovering from as low as 180 basis point of expansion to as high as 300 basis point of expansion. So net at an coverage universe level, when we look at the margins, we are expecting the EBITDA margins to go up from 14.7% in FY23 to about 16.9%. Now, this is a 220 basis point of a margin expansion, but it will still be lower than the 17.4% that we clocked in FY22. So this is definitely a recovery from where we are, but still well below where we were in FY22 itself.
Gautam, very quickly, you kept saying that even after the margins rise in FY24, they will still be lower than the pre-COVID levels. Which are the sectors where there is a maximum gap in terms of margins compared to pre-COVID levels, and some numbers over there? And what can drive that margin recovery? And secondly, just wanted to get your thoughts in on IT and what we heard from HCL Tech overnight.
Yeah, so let me come back to the second question first. On IT, clearly you will see a lot of volatility in commentary happening as we move forward because the global macros are still not settled. Stock price reaction will always be disproportionate on either side. So you saw HCL Tech yesterday lowering their guidance band by about 100 basis points, and stock is down, I think, somewhere 5-6%. You will expect a similar kind of a reaction when guidances are raised as we move forward or whenever it happens. In the short term, obviously, it's always going to be very difficult to predict where the dust will settle because you're dealing with a very volatile macro where things are changing every fortnight. From our point of view, we like the sector because it offers very strong cash flow generation capabilities and a well-demonstrated track record over the last 3 decades where especially the large cap IT has navigated all the macro shocks very well and have emerged stronger after every crisis, whether it is 9/11, whether it is Y2K, GFC, COVID. So we don't expect anything different going forward. In the short term, obviously, there will be problems as they navigate the current macro environment. But we would think that current valuations do offer a good opportunity from a slightly medium-term viewpoint. So we will be buyer there, and we have a slight overweight stance in IT.
Okay, just sorry. Gautam, just sorry, we're running out of time. I just want to squeeze in one question because cement is your, sector which tops your list, right, as the maximum potential to gain margins. This is a sector that has come back in a big way in the sense everything's falling in place, whether it's a pickup in demand, whether it's prices stabilizing, and now raw material costs cooling off as well. But a lot of these stocks have already gotten re-rated. I mean, JK Lakshmi Cement, for example, in the smaller guys. Do you think there is more upside left, or has a large part of it been juiced out already?
No, I agree. A lot of this improvement is already reflected and is getting discounted in the current price because they have moved up. I think something like an Ultratech, which was 5,500, is now somewhere about 7,000. So a lot of the expected improvement in the operating margins is getting reflected there. For example, cement did an EBITDA per ton of 565 rupees in the quarter which has just gone by, which was at a decadal low. And we are expecting about 200 to 300 basis point of improvement in EBITDA per ton as we move forward. So it's very important to be very stock specific in some of these sectors because a lot of the expected improvement is getting reflected in some of those stock prices already.
All right, Gautam, we got that. Thank you very much for joining us and taking out the time to speak with us today. That is Gautam Duggad of Motilal Oswal telling us that there is going to be a big margin recovery